Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Wednesday, the 23rd of November, 2022. It's the day before Thanksgiving, so I would be remiss if I didn't stop and give thanks. So let's do that before we dive into this week's updates on the economics and stock market environment in which we find ourselves. First and foremost, I give thanks to you, our clients. I remain humbled and honored, as is my entire team. We are humbled and honored to serve you. And we certainly thank you to all of you who have been introducing us to friends, family, colleagues, etc. We certainly give thanks to those of you who have already subscribed to our YouTube channel. That's a nice hint for those of you who have not. Please click the button that should be right below this video and subscribe to our channel. I also want to give thanks to the amazing team. I've been very blessed to build the team that we now have. We work really well together, and as the Lord has blessed the business, we are creating more and more specialization within the team, which I believe serves our clients even better. And one of the ways that we gave thanks here recently, we got together over a campfire and had just outdoor games and fellowship as a team and our families. And I had recently learned that too many of the team members had never had pie iron pizzas. So my wife worked the ingredients and I cooked them over the fire, and everybody loved them. So if you've never had a pie iron pizza, find yourself a campfire and do yourself a favor and make yourself one of those. Having said that, before we pivot and talk about the stock market as well as look at some economic data, I want to remind you, if you are trying to do a Roth conversion, or you're trying to do a qualified charitable distribution, or even just a required minimum distribution, naturally the year is drawing to a close, so you really want to try to take a look at that really soon. On the screen right now is our updated chart for the historical comparison. Again, every single one of these lines represents one of the years since 1976 when I was born. And what I'm just simply trying to show is the fact that 2022 is the third worst year on record since I've been born. Here we are representing the returns for the S&P 500 for every midterm election year since the S&P 500 was created. And what you can easily see is that there was a couple of very good years, there's a couple of very bad years, and then there's a handful of average negative and a handful of average positive and a handful of flat years. However, as this year draws to a close, what many are naturally wondering is, what should we expect the year after a midterm election year? So let's look at that data. So here we have every year after the midterm election year. Clearly, there is a positive bias to the year after a midterm election. There's a couple of notable exceptions. 2015 clearly stands out as the only negative year the year after a midterm election. 2011 obviously stands out because it looks like the data is missing. It's not actually missing. This is from a report that I put together for my team as well as for other advisors who subscribe to our research. And what I'm simply trying to highlight is the fact that on December 31, 2010, the S&P 500 closed at 1,257.64. 1 year later, it closed at 1,257.60. That's pretty flat. But overall, we see a very positive bias to the data the year after a midterm election year. So on the screen right now is the S&P 500. The black line represents the 200-day moving average. And again, that is generally considered an indicator of the long-term trend. So right now we are trading below the 200-day moving average, so we're considered to be in a downtrend. However, we can see that on October 13th, it appears that that date was the low of the year, and we have rallied off of that for the last month. Now, we're getting really close to this 200-day moving average, but in particular, I want to call your attention to August. I think it was August 16th, and then we'll call attention to late April. And in particular, what I want you to see is when we get to this 200-day moving average, it can act as resistance. So far this year, it has done that a couple of different times. And so as this stock market is rallying into that 200-day line, there's naturally a concern that the 200-day moving average is going to again act as resistance. The question that we want to ask ourselves is, do we think this time is different? Do we have any data to suggest that this time we might actually be able to cross the 200-day moving average and hold it and begin a new uptrend? Let's look at what we call the participation level. And so what we want to do is look underneath the surface to find out how many stocks are participating in this rally. So on the screen right now, again, we have the S&P 500, but in the bottom pane, I'm showing the percent of the S&P 500 that is above the 200-day moving average. Again, on the far right of the screen, you can see that the S&P 500 as a whole is not above the 200-day moving average. But what I'm showing you is that 56% of the S&P 500 is already above the 200-day moving average. So that is a healthy sign. You'll recall that we said that August 16th of this year, the S&P 500 kissed the 200-day moving average. But look below. Look now at the percent of the S&P 500 that was above the 200-day average at that time. At that time, it was only 46% of the S&P was above that average. So again, the fact that we now sit with 56% of the S&P 500 above the 200-day, that doesn't necessarily allow us to draw firm conclusions that this rally is going to hit the 200 and it's going to keep on going. We can't say that definitively, but the fact that we're already above 56% is indeed a very encouraging sign. Switching gears and talking about some of the economic data points, on the screen is the federal funds rate. We're not going to go into tremendous detail here. We've talked about this ad nauseum all year long. I'm bringing it up to point out that we do expect the Federal Open Market Committee to raise rates again next month. When they do, it is possible that the mortgage rates will also go up. Now, the mortgage industry is obviously employing a lot of economists as well. And what they're doing is they're saying, hey, well, we believe the Federal Reserve is going to raise rates in December. So sometimes what they're doing is they're baking that in their rates now. So sometimes when the Federal Open Market Committee raises interest rates, we actually see the mortgage rates go down, because what the Federal Open Market Committee does sometimes is they raise rates at a slower pace than what the banking industry had anticipated. So it's not a one-to-one correlation. But again, the point that I'm trying to make here is look at the steepness and how quickly the rates have gone from very, very low to multi-decade highs. Now, what that's doing is it is obviously having an impact on the housing industry. This is a housing starts. So this is new housing that, and what I've drawn that black line, and what I'm trying to show you is that we are currently below trend. Now, the Dallas Fed has indicated here recently that they would not be surprised if housing prices go down by as much as 20%. I'm not suggesting that I agree with that or not, but we are expecting the housing market to continue to suffer, and that does drive, the estimates are about 15% of overall GDP. So that's not good news. The last economic data point that I'll mention for today is our yield curve. This again is the 10-year yield minus the 3-month yield. And when this goes below the zero line, that's the zero line is a black line that's on the chart. When the 10-year minus the 3-month, when it goes below zero, that is called a yield curve inversion. And this yield curve, according to Dr. Harvey Campbell of Duke, this version of the yield curve does the best job of indicating recessions. So even though the stock market is recovering, this yield curve is still negative. And if we zoom in, it's getting more negative. So the last thing that we'll mention for today is the updated contribution limits for 401ks and IRAs, etc. So we mention this now because as the year draws to a close, one of the things that we encourage you to do is refresh your budget and your planning for the new year. And if you have the financial ability to increase your contributions to your company-sponsored retirement plans or your IRA, if that's appropriate, then we encourage you to go ahead and bake that into your budget for the new calendar year. Sometimes your contributions will automatically increase at your employer. Sometimes you're going to have to manually go in and do them yourself. If you are set to maximize your contributions this year, keep in mind that won't necessarily allow you to maximize the contributions next year. Bottom line, take a look at your employer-sponsored retirement plan and see if you need to make any adjustments based on the fact that contribution limits have increased. That's it for today. I thank you for watching. Again, we have the office in Cary, North Carolina, as well as Southern Pines, North Carolina. If you have any questions, by all means, feel free to reach out to us. We'd love it if you'd leave us a comment. Tell us what you'd like to see in one of our future videos. And feel free to reach out to us if you have any questions. We'd be happy to see if we can be of service. Again, thank you for watching, and happy Thanksgiving to you all.